Welcome to the Property Code. I am Nick, and today we are diving into one of the biggest questions people are asking in 2025. What is the best investment plan for this year? Search data across the United States shows a massive spike in phrases like best way to invest money in 2025, where to invest now, safest investment with high return, and how to build a portfolio in a volatile market. This surge is not just curiosity, it reflects uncertainty. After years of inflation swings, high interest rates, and unpredictable markets, Americans want clarity. Let me start with a story about Marcus. He is 40, lives in Denver, and works as a mechanical engineer. For most of his life, Marcus followed the standard advice: save diligently, contribute to a retirement account, and hope compounding would do the rest. Then 2022 and 2023 happened. Inflation cut into savings, markets swung violently, and real estate prices soared out of reach. By the start of 2025, he had one question that millions share: how do I invest without losing sleep? The truth is, there is no one-size-fits-all investment plan anymore. The best plan for 2025 is balanced, flexible, and personalized. But it begins with understanding what kind of world we are living in. Interest rates are still higher than the previous decade, but inflation is stabilizing. The Federal Reserve has signaled potential cuts later this year, which could push both the stock and housing markets upward again. Artificial intelligence, green energy, and digital assets are transforming industries, while real estate continues to offer stability for those who play long-term. The new investor must think like a strategist, not chasing hype, but positioning early. Marcus began by organizing his financial foundation. He looked at his income, debt, and liquidity. Before investing $1, he built what he called his resilience fund, 6 months of living expenses in a high-yield savings account, earning over 4.5% annual yield. This gave him security and the freedom to invest without fear. Then he divided his remaining capital into 3 categories: growth, income, and innovation. His growth investments included broad index funds tracking the S&P and NASDAQ. These offered exposure to the strongest companies in the world without needing to pick winners. He automated monthly contributions so that he could buy consistently regardless of market noise. In 2025, dollar cost averaging remains one of the most powerful tools for long-term investors. For income, he looked at real estate, specifically rental properties and real estate investment trusts, or REITs. The rental market in mid-tier cities like Tampa, Raleigh, and Phoenix continues to expand as affordability pressures push people away from coastal hubs. With programs like DSCR loans and fractional ownership platforms, investors can now participate in income-producing real estate with lower barriers. Marcus invested in a small multifamily property with a property management team handling operations. The cash flow covered his mortgage, and appreciation potential gave him long-term upside. Then came the innovation category. Instead of speculating, he researched trends shaping the decade. Artificial intelligence infrastructure, renewable energy, and blockchain-based assets dominated the landscape. He allocated a small percentage of his portfolio to exchange-traded funds focusing on these sectors. His reasoning was simple: not betting everything, but betting something. Innovation is volatile, but exposure to transformative industries ensures your portfolio evolves with the world, not against it. One of the most overlooked opportunities in 2025 is tokenized assets, real-world investments recorded on blockchain technology. Real estate tokenization allows investors to buy fractional shares of physical properties with transparent ownership and tradable liquidity. Platforms that combine compliance, blockchain verification, and dividend distribution are bringing institutional-grade opportunities to individual investors. Marcus invested a small amount in a tokenized commercial property fund, attracted by its low entry point and regular income distribution. Diversification was his armor. Instead of relying solely on traditional markets, he balanced multiple streams: stocks, real estate, digital assets, and high-yield cash instruments. This approach insulated him from volatility while keeping him exposed to growth. The modern investor cannot afford to think in isolation. In 2025, diversification is not just about asset classes, it is about access. You must own pieces of industries, geographies, and technologies shaping the next decade. Marcus also focused on tax efficiency. He used Roth IRA and solo 401k accounts to shield long-term gains from taxes. For real estate, he leveraged depreciation and write-offs to reduce taxable income. In 2025, smart investors think not just about returns, but about what they keep after taxes. Every dollar saved in taxes is another dollar invested in freedom. Perhaps the most underrated part of an investment plan is behavior. Markets move, headlines scream, but discipline builds wealth. Marcus automated everything. His savings transferred weekly, investments executed monthly, and rebalancing occurred quarterly. This removed emotion from his decisions. When markets dipped, he bought. When they soared, he stayed calm. Long-term consistency outperformed short-term brilliance every time. He also integrated education into his plan. Instead of blindly following influencers, he set aside 30 minutes each week to read market reports and real estate news. Understanding context kept him from reacting to fear. In a world where information moves faster than ever, staying informed is an investment itself. The broader trend for 2025 investors is simplicity over speculation. People are rediscovering that wealth is not built on timing, but on time. The best plan is one you can execute consistently. Whether your goal is passive income, early retirement, or financial independence, your investment roadmap must include three pillars: stable income, capital growth, and inflation protection. For those starting from scratch, the sequence is simple. First, build your emergency fund. Second, eliminate high-interest debt. Third, automate your investments into diversified assets. And finally, learn to evaluate opportunities, whether that is a rental property, a stock, or a new business. The key is discipline, not drama. By the end of the year, Marcus had achieved what he once thought impossible. His net worth had grown steadily, his income diversified, and his stress dropped. He realized that true wealth is not about chasing returns, but about designing a system that works while you sleep. His plan was not flashy, but it was bulletproof, adaptable, diversified, and sustainable. In 2025, the best investment plan is not the trendiest, it is the one that aligns with your life. If you are young, focus on growth and learning. If you are established, focus on stability and income. If you are building wealth for retirement, prioritize protection. The modern investor is part analyst, part visionary, and part risk manager. You do not need to predict the future, just position yourself to benefit from it. The next decade will reward those who understand one simple truth: money follows discipline. Whether your path is through real estate, technology, or stocks, your greatest asset is time. Start small, stay consistent, and let compounding do what it has done for centuries: turn patience into prosperity.